the mining metrics started to become important as the hash rate started to fall off the network. Then that's a long-term investor inside Coinbase. That's not a speculator. Oh, I just, it's an evolving field, and I'm just speaking to my newsletter. I launched in October. There's been 28 letters, and then, each one goes on record. And so 80% of the short time frame stuff, which looks out over the next 2 to 3 weeks, have been reliable. 20% have been wrong. 80% have been correct. The longer time frame stuff, that tends to be more reliable because it's easier, long time frame, you can tell these long-term movements. But like the short time frame stuff, the kind of stuff that a speculator might use to help them as part of the arsenal, that's the Backtrace reliability, at least from my analysis. Well, it's a lot of it deals with backtraces. Right? You often explore an idea. You explore an idea, you run it on a test bench, you grab the data and you go, well, if this is true, I will, build that model mathematically, and then let's plot what that signal says, and then we run it, because we've got 12 years. That's the other thing with Bitcoin, you've got 12 years of backtrace. And then you go, this is what the signal said over 12 years. And if it's promising, and often the last maybe 2 years to sometimes 8 years, if it's really good, it goes all the way back. It gives you a very area in which it's worked, because it just so happens that the network is in this kind of evolution, and so before a particular epoch, things were different. Like, for example, NVT, where we looked at volume, it was quite reliable for 8 years.
This is the network value to transaction ratio.
That's correct. The ratio, the PE ratio for Bitcoin, the ratio of investor volume to the market cap. And that worked very well up to maybe 2018, 2019. But since then, I've had to add layers and layers of corrections on it to really correct for this evolution of the Bitcoin network, which is all the activities moved to the exchanges. So long-term investors are buying their coins and they're leaving it on Coinbase, and that's that. And so when that long-term investor sells to another long-term investor, they sell it on Coinbase and someone else comes in, then that's a long-term investor inside Coinbase. That's not a speculator. So there's just been massive move to exchanges. We've had movements of coins into custody providers who are generating yield, like BlockFi. So there's these kind of different products that are being introduced, and of course the movement of coins become the behavior changes. So when I used to see volume moving, it used to be in the 2016 era, people buying and selling between each other. Maybe they send it to the exchange and then they send it and it comes out to someone else. So there's maybe a third party in the way. But nowadays, someone could send their coins to BlockFi to generate yield. They're not selling their coins. And then they might get their coins back later when they don't want to. Maybe BlockFi just reduced their payout to a tiny percent, less than 1%, 0.1%, something like that. So they may decide to recall their coins back into cold storage. And that previously looked like investor activity going from one investor to the other. But obviously now in the changing face, that doesn't hold true. And so you kind of get false signals because that has happened. It's a constant, it's I wouldn't say cat and mouse game, but it's constant process of continually looking at what's happening with the network, trying to understand a particular facet, and then trying to build a metric around that, and then understanding what that is. And sometimes you can get some pretty good signal of what's happening. But like certainly the demand and supply side of things is that's much more reliable than these other stuff that we look at. But they all come into it in different times. Like we had the mass exodus of mining out of China. And so suddenly the mining metric started to become important as the hash rate started to fall off the network, and the blocks started to process slower. We needed to understand that because the volume started to, the transaction rate started to reduce because the network was running at 1/3 speed. So that stuff needed to be accounted for. And we needed to look at the coins that the miners had and seeing what they were doing. And some of them sold, which was a sign of them either getting out of business or selling to fund a relocation. So you see all sorts of stuff like that, which often does not matter until it matters because a key event happened. And, if you go to Glassnode, they must be up to like 400 different views into the network, 400 different charts where they're looking at different aspects of that network. And you as an analyst can get in there and, you've got your Lego bricks, go to it, try and make sense of that stuff. And then there's one very key metrics that other analysts have created where you can just kind of look at it and get kind of a glimpse of what's happening in the macro sense.